and welcome to The Harvest with me, Carmel Fisher, where we bring you the latest in capital market news, views, and clues. In today's weekly roundup, we take a look at why the Fed needs to cut interest rates sooner rather than later. Mohammed El-Erian, economist, businessman, and president of Queen's College, Cambridge, and chief economic advisor at Allianz, says while exact timing of the first rate cut may seem less critical, it is actually vital for determining the overall impact of the rate-cutting cycle on the economy. More concerns mounting in the West as Russia and North Korea sign a partnership deal that appears to be the strongest since the Cold War. We look at regulatory wrist slaps from the SEC. One, they are charging Skechers with making undisclosed payments to executives' family members. The second wrist slap is, again, for Elon Musk, an investigation that could hit Tesla's stock. We also take a look at the EV industry's taking a knock in general, plans that are being taken by certain companies to ride out weak demand. As always, we bring you the latest in AI developments. Humanoid robots step into the driver's seat, while AI pioneers turn whistleblowers and demand safeguards, almost directly resulting in OpenAI co-founder announcing his new AI startup, Safe Superintelligence. This and so much more on The Harvest. The Federal Reserve must cut interest rates sooner rather than later, said Mohammed El-Erian, president of Queen's College, Cambridge. El-Erian points out that many market participants are currently fixated on whether the Federal Reserve, reassured by the latest inflation data, will begin its rate-cutting cycle in September or delay it further, as suggested by several Fed officials. However, analysts believe this view underestimates the importance of the timing of the first cut. In current circumstances, the timing is crucial for determining the cumulative magnitude of the cycle and the economy's well-being, El-Erian said in his article for the Financial Times. Typically, the timing of the first rate reduction allows markets to price in the entire cutting cycle with more confidence. Yet, this is less relevant today, given the Federal Reserve's data-dependent approach, which appears to lack a strategic view. Here's more from Boston Fed President Susan Collins.
I think we have learned that there's no crystal ball, that there's no preset path. We have to let the data tell us, and it's not one or two indicators. It's looking more holistically at the information.
Are you looking at one or two rate cuts at this point, given where things are?
I could imagine scenarios that would be consistent with both. I mean, I think that as I look forward, my view of how much easing might be appropriate this year has been reduced as I looked at the data, and that's consistent with the summary of economic projections that all of the participants put forward last week. And so I think one way to think about that is that there are different scenarios.
And to the question of holding rates so long to see a sustainable move towards a 2%, that perhaps this is the reason that may result in a recession. Here's what Susan Collins says.
Risks are absolutely two-sided, and both sides of our mandate are top of mind for me. So I do think that there is a risk that if we held too long, we would see more slowdown than we need. And that's something that I watch carefully. You know, I think that labor markets are still strong. I think they are not overheated the way that I would have described them earlier, but continuing to watch what's happened across a range of indicators in that space is also important in terms of the timing that will be appropriate to change the stance. So it's balancing the risks of prematurely easing, and it would be, you know, if we prematurely ease, we're just going to make it that much harder to do the work we need to do.
Mounting concerns as Russia and North Korea sign partnership deal that appears to be the strongest since the Cold War. Russian President Vladimir Putin and North Korean leader Kim Jong-un signed an agreement on Wednesday that pledges mutual aid if either country faces aggression, a strategic pact that comes as both face escalating standoffs with the West. Details of the deal were not immediately clear, but it could mark the strongest connection between Moscow and Pyongyang since the end of the Cold War. Both leaders described it as a major upgrade of their relations, covering security, trade, investment, cultural, and humanitarian ties. The summit came as Putin visited North Korea for the first time in 24 years, and the US and its allies expressed growing concerns over a possible arms arrangement in which Pyongyang provides Moscow with badly needed munitions for its war in Ukraine, in exchange for economic assistance and technology transfers that could enhance the threat posed by Kim's nuclear weapons and missile program. From North Korea, Putin traveled to Vietnam, where he exited his plane onto a red carpet and briefly shook hands with dignitaries, while soldiers in white dress uniforms stood at attention. In Hanoi, Putin is scheduled to meet with Vietnam's most powerful politician, Communist Party General Secretary Nguyen Phu Trong, and new President Tu Lam. The Russian leader seeks to strengthen ties with a longtime partner. On to the SEC and their regulatory wrist slaps. The Securities and Exchange Commission today announced that Skechers USA Inc., a footwear company based in California, agreed to settle charges for failing to disclose payments for the benefit of its executives and their immediate family members. Skechers agreed to pay a $1.2 million civil penalty to settle the SEC's charges. According to the SEC's order, from 2019 to 2022, Skechers did not comply with related person transaction disclosure requirements when it failed to disclose its employment of two relatives of its executives and did not disclose a consulting relationship involving a person who shared a household with one of its executives. Furthermore, according to the SEC's order for multiple years, Skechers failed to disclose that two of its executives owed more than $120,000 to the company for personal expenses that had been paid for by Skechers but not yet reimbursed by the executives. The SEC's order finds that Skechers violated reporting and proxy solicitation provisions of the Securities Exchange Act of 1934. Without admitting or denying the SEC's findings, Skechers agreed to a cease and desist order and to pay the civil monetary penalty referenced in the story. On to Tesla. The Securities and Exchange Commission's investigation into Tesla's chief executive, Elon Musk's tardy disclosure of his growing Twitter stock holdings in April 22 could land him in more hot water with regulators. Actions could include asking a court to bar the billionaire from serving as an officer or director of a public company, according to the Wall Street Journal. Tesla shares surged Monday. The Wall Street Journal reported Monday that Musk waited to disclose his Twitter stake until he owned more than 9% and had an offer to join its board. This appears to violate a rule that required him to reveal his ownership once it passed 5% of Twitter shares. In April of 2022, Musk disclosed his Twitter ownership 11 days after the regulatory deadline. The SEC has said it is probing whether Musk committed civil fraud by delaying his disclosure or misleading the market. Tesla shareholders last week voted in favor of giving Musk his 2018 $56 billion pay package and reincorporating the EV giant in Texas, moving it from Delaware. After 5 weeks of tight closes, Tesla stock appears to have forged a new base with the 198.87 buy point, according to market search charts. However, it is still below its 200-day moving average, and it is in a downtrend. Tesla declined 2.8% in May and remained down around 30% in 2024. However, Tesla has rallied since reporting first quarter earnings and revenue on April 23rd, finding support just above its 50-day moving average on April 22nd. Tesla stock hit a 52-week low of 138.8. The EV industry in general has taken a knock, and this seems to be primarily due to weakened demand. Market leaders now plagued with the question, could electric vehicle EV makers have moved too aggressively into the marketplace without first convincing the motoring public that replacing gas-powered cars with EVs is the right one and at the right time? It's looking like that for sure. EV sales have risen over the past few years, but that fast manufacturer push for massive EV adoption by 2030 has definitely stalled. In a sobering revelation from a Boston Consulting Group study, the vast majority of potential EV adopters want three things to happen before they'll seriously consider switching from gas to EV. They want under 20-minute charging times, a 350-mile plus driving range, and a sticker price of under $50,000. With only one EV, the Hyundai Ioniq 6 SE-RWD long range, meeting those criteria, the industry has a long way to go.
There are larger economic challenges. Interest rates are up, and so borrowing money is a lot more expensive. Inflation has reduced purchasing power, and supply chains are disrupted. The inflexible nature of the EV supply chain is pressuring OEMs to make EVs despite consumer pullbacks. Then there are the pressures of meeting government mandates.
Think of the lens of the manufacturer, where it typically takes a cycle time of upwards of 7 or 8 years from inception to showroom floor and wheels rolling, right? So that's a big ship to turn. And when back to the mandates, the regulatory pressures, when you have to meet those, it's not like you can just throw a switch and convert from combustion to electric.
Fisker filed for bankruptcy protection on Monday, the latest electric vehicle startup to succumb to fundraising difficulties, slow sales, as well as supply chain and distribution challenges. Demand has been weak for Fisker's flagship Ocean electric SUV. The company cut jobs and paused investments to slow cash burn, partnered with dealerships to boost sales, and desperately sought an investment from a major automaker to stay alive. None of that worked.
The softening of sales isn't just happening for legacy brands. The buzzed-about luxury EV brand Lucid has seen 2 consecutive quarters of weaker-than-expected demand. Most recently, it delivered 600 fewer of its high-performance, 500-mile range luxury Air sedan than Wall Street had expected in the second quarter of 2023.
Rivian this year shut down its assembly line for weeks to retool the facility, a move meant to reduce costs and help the maker of R1S SUVs and R1T pickup trucks turn profitable. Nikola pivoting to big rigs powered by hydrogen after some of its battery electric trucks caught fire in August and forced a recall. The company expects up to $170 million in truck revenue for 2024, with a target to sell 450 units this year, including its hydrogen fuel cell electric trucks. And now for the fast-moving AI developments. Humanoid robots step into the driver's seat while AI pioneers turn whistleblowers and demand safeguards. This immediately resulting in OpenAI co-founder announcing his new AI startup, Safe Superintelligence. Just a few hours ago, Nvidia and Dell shares rise on the news of an AI factory for Elon Musk's xAI. So much more detail coming up. Stay tuned. Humanoid robots can drive cars. Well, sort of. The researchers, one of whom consults for Toyota, developed and trained a musculoskeletal humanoid called Musashi to drive a small electric car through a test track. Equipped with 2 cameras standing in for human eyes, Musashi can see the road in front of it as well as the views reflected in the car's side mirrors. With its mechanical hands, it can rotate the car's key, pull the handbrake, and switch on the turn signal. And thanks to its anti-slip feet, Musashi can press on the accelerator or brake pedal. After teaching Musashi how to use the car's steering wheel by feeding it raw sensor data, the researchers managed to get the robot to turn a corner at an intersection while respecting traffic light signals, they claim. But there are caveats. For one, Musashi only gingerly lifted its foot off the brake pedal to turn the corner rather than tap the accelerator. This was the result of technical limitations and out of an abundance of caution, the researchers say. But as a result, the turn took about 2 minutes. So clearly there's some work to be done. Unfortunately, the researchers say they're up for the challenge with plans to develop a next-gen robot and software. Maybe a few decades down the line, Musashi will be behind the wheel of your next Tokyo taxi. AI pioneers turn whistleblowers and demand safeguards. OpenAI is facing a wave of internal strife and external criticism over its practices and the potential risks posed by its technology. In May, several high-profile employees departed from the company, including Jan Lake, the former head of OpenAI's super alignment efforts to ensure advanced AI systems remain aligned with human values. Lake's exit came shortly after OpenAI unveiled its new flagship GPT-4o model, which it touted as magical at its spring update event. According to reports, Lake's departure was driven by constant disagreements over security measures, monitoring practices, and the prioritization of flashy product releases over safety considerations. In response, a group of current and former employees from OpenAI, Anthropic, DeepMind, and other leading AI companies have penned an open letter addressing these risks. The letter, which has been signed by 13 employees and endorsed by AI pioneers, outlines 4 core demands aimed at protecting whistleblowers and fostering greater transparency and accountability around AI development. 1. That companies will not enforce non-disparagement clauses or retaliate against employees for raising risk-related concerns. 2. That companies will facilitate a verifiably anonymous process for employees to raise concerns to boards, regulators, and independent experts. 3. That companies will support a culture of open criticism and allow employees to publicly share risk-related concerns with appropriate protection of trade secrets. And 4. That companies will not retaliate against employees who share confidential risk-related information after other processes have failed. The demands come amid reports that OpenAI has forced departing employees to sign non-disclosure agreements, preventing them from criticizing the company or risk losing their vested equity. As the AI revolution charges forward, the internal strife and whistleblower demands at OpenAI underscore the growing pains and unresolved ethical quandaries surrounding the technology. OpenAI co-founder Ilya Sutskever, who left the artificial intelligence startup last month, introduced his new AI company, which he's calling Safe Superintelligence, or SSI. "I'm starting a new company," Sutskever wrote on X on Wednesday. "We will pursue safe superintelligence in a straight shot with one focus, one goal, and one product." Sutskever was one of the OpenAI board members behind the attempt to oust co-founder and CEO Sam Altman in November. Altman and Sutskever, along with the other directors, clashed over the guardrails OpenAI had put in place in the pursuit of advanced AI. According to their website, SSI.inc, "We approach safety and capabilities in tandem as technical problems to be solved through revolutionary engineering and scientific breakthroughs. We plan to advance capabilities as fast as possible while making sure our safety always remains ahead. This way, we can scale in peace." In breaking news, Elon Musk announced that Dell Technologies and Supermicro Computer will be providing hardware for his artificial intelligence project. Musk said the two companies would be involved in assembling the supercomputer that his startup, xAI, is building. Dell CEO Michael Dell also noted that Dell was working with Nvidia to create a factory to power xAI's chatbot, Grok. Shares of Dell Technologies and Supermicro Computer, also known as Supermicro, rose in intraday trading Thursday after Elon Musk announced that the two tech firms will be developing hardware for his xAI artificial intelligence startup. Musk launched Grok in November as a challenge to OpenAI's chatbot ChatGPT. He also sued the Microsoft-backed firm and CEO Sam Altman in March, claiming they violated OpenAI's founding mission to ensure that artificial general intelligence benefits all of humanity, although he dropped the lawsuit last week. As of 11:38 a.m. ET Thursday, shares of Dell were up 2.4% to $152.69 per share. Supermicro Computer gained 7.5% to $998 per share, and Nvidia rose 2.4% to $138.80 after the AI chipmaker Tuesday overtook Microsoft MSFT to become the world's most valuable company.
Dell and Supermicro also rallying after Michael Dell said the company is building a Dell AI factory for Elon Musk's startup xAI. Bloomberg Technology co-host Ed Ludlow joins us now for more. Ed, give us the details.
Well, it directly relates to what Abby was just talking about in Nvidia, because an AI factory is just a new term that Dell's come up with for server racks, rows and rows of server racks in a server farm. And this is all played out over social media in the last 24 hours. As you said, Michael Dell posted on X that they're making AI factories for xAI to develop Grok. Supermicro was then thrown into the mix by Elon Musk himself, saying that they will also have a part of it. What I find so interesting about this is you can kind of do the math. We talked a lot, you and I, Kate, about how in the context of AI chips, it's not just something you can hold in your hand. It's not just a chip. It goes into a server rack that includes networking gear, storage, high bandwidth memory chips. But our colleagues at Bloomberg Intelligence have basically said, if Dell get just 50% of the xAI deal, and it's to develop Grok 3, the latest generation large language model from them, and you price each server rack at $1 million, it could be a deal that is valued up to $3 billion.
That's it for your weekly roundup. Stay safe out there, everybody. Available on Apple Music, Spotify, and anywhere you find your podcasts.